Hi, I'm Benjamin Day with Pikes Peak Urban Living and Selly Group Real Estate, and I'm here to present in video format our 2014 annual report and forecast. The first thing I want to start with is where we ended last year compared to where we ended the year before. So taking a look at a couple of critical numbers, 2,090 versus 3,213, 1,337 versus 1,116. The first number up here represents the active listings that were on the market on December 31st, 2012. So these are your 2012 numbers. That looks more like a 2, and these are your 2013 numbers. Over here, 3,213 active listings on December 31st, 2013. This is the number of pending sales, 1,337 and 1,116 this year. When you take a first couple glances at these numbers, what you'll see is, okay, that's about a 300 unit difference between these two. And over here you look at it and go, okay, that's about a 200 unit difference. There were 200 more pendings last year, and there were 300 more active listings this year. But if you look at that as a ratio, that's where it starts to get interesting. Because over here we have more of a 2-to-1 relationship, and over here we have more of a 3-to-1 relationship. So if it was 2-to-1, there were 2 active listings for every pending that was happening. Buyers were going out looking at houses. They'd look at 4, 2 would sell. This year they're going out looking at them. They'd look at 6, 2 would sell. It's not quite as panicked as it was this time last year. So the buyer's perception of the marketplace, and why are buyers important? There's no market without them. Buyers rule the market. Doesn't matter if it's a buyer's or seller's market. There's no market without them. Last year, their perception was, tight, panic, supply and demand's tight. This year, it's like, okay, it's a seller's market. We'll keep looking. We know there will be more listings. Another thing that was fueling buyer activity last year, in December, rates were at 3.35%. Not sure if you can see that, but this is 3.35. And right here is 4.46. That's where the rates are at the end of December 2013. That's a pretty big difference. That is an 11% difference in monthly payment between those two. That 1.1% increase in rate translates to an 11% cost of borrowing difference. And if you add to that a 6.1 cost of appreciation that increased across the board in the Pikes Peak MLS in 2013, you're looking at 11% plus 6.1%. It is 17% more expensive for the borrower this January than it was last January. So when we put together our annual report this year, we're predicting that there will be 800 fewer single-family sales than there were in 2013. And we realize that most people think that the market's only going to get better, that we're in recovery mode, that we're going to continue to see improvements. And there will be improvements, but in terms of gross unit sales and in terms of any real major increase in price, we don't think that we're going to see that. In fact, we'll probably see 800 fewer sales. And that's a prediction, and we're probably going to be wrong because it's hard to nail these numbers. But when we see that sort of market trend happening, how is that going to impact quarter 1 and quarter 2 of 2014 compared to what that did to quarter 1 and quarter 2 of 2013? What this did over here was critical. Just replaying history here and what we saw last year. I'm going to spritz the board. Look, I can do it without looking. Helps when I've got a camera. Last year, how good was 2013? 67% and change. That's how probable it was that a house would sell. That's very probable. Taking a look at 67%, most sellers have seen that in their neighborhood. Signs have gone up, signs have gone down. They had a 2 in 3 chance of selling their house. That beat 2005's probability by 3%. 2005 was the most probable year in MLS history prior to selling your house. It was the best year for a seller to put their house in the market and get it sold. It was never more probable. They've also seen that price increase happen. But what they've seen happen and what they might have heard are probably two different things. Colorado Springs increased at 6.1%. But if you listen to national averages, you will hear everything from 8 to 14%, depending on if you're listening to CoreLogic, if you're looking at Zillow, if you're looking at FHFA.gov. And if you're looking at Case-Shiller says that the Denver marketplace has eliminated all of the real estate bust drop and is now at an all-time high as far as its price. And that market's just 60 minutes up the road. So sellers are hearing all of this positive news, and they're seeing the probability of sale happening. We expect the listings that show up in the first quarter into April and May to be plentiful, to increase the market supply that's sitting out there, and to be overpriced. And when you're plentiful and overpriced and interest rates are expensive and the buyers are paying 17% more than what they would have paid at this time last year, we think that there's going to be an impasse and a standoff that's happening in the first couple quarters of this year. It's the problem of having such a good 2013. 2013 last year, we showed up for work in January and the phone was ringing and it wasn't sellers. This year the phone's ringing and it's sellers. Last year the phone was ringing and it was buyers. And what happened last year was this boom that happened in the market, and then it just kind of tapered off as the year progressed. What we think this year is going to look like is a lot slower in the first couple quarters, and then it's going to end up getting closer to that outcome as the year progresses. But there's no way pendings and closings are going to keep up at the pace that they were the first 4 or 5 months of last year, with rates being higher. In the Colorado Springs marketplace, 7 out of 10 transactions are under $300,000. We have an average sales price last year of $244,000. What that means is that we are a very interest rate dependent marketplace. Last year, between the first week of May and the last week of June, we saw an interest rate spike that was very similar to what I showed you in December of 2012 versus December of 13. It went from 3.3% all the way up to the mid-4s, and it did that in 47 days. And people continued to buy houses despite that increase in rate because it was the peak season, because there already wasn't much inventory. But the inventory built out a little bit over the summer months into the fall months, and we saw the number of sales slow down. What's interesting is that if you look at the over $500,000 market, there were exactly the same number of sales the first 6 months of the year as there were the last 6 months of the year. Only 4.5% of the marketplace sells over $500,000, but the interest rate gains really had no impact in that marketplace because that market is less susceptible to interest rate volatility. But 7 out of 10 transactions are less than $300,000. And many of those people are the move-up buyers that move from that product into another product, a more expensive product. So what we're projecting here is a slower start to 2014 that the market never catches up from. If you're talking about the gross units over the course of the year, we're talking about a single year's forecast. We're not talking about the health of the real estate market in general. But what we're saying is that the first quarter into the second quarter is going to be slower for sure than the first quarter and second quarter of 2013. Our estimation is that the market will continue to show some signs of improvement in third quarter and fourth quarter because that will be the time that buyers start making this important distinction. The distinction between worth and the distinction of value. We are still in a recessionary climate in Colorado Springs with higher than statewide and higher than national averages in unemployment. We have a focus that tends to be, is it a good value rather than, is it worth it? A worth it has to do with a personal preference. It has to do, is this the right decision for me? Is this the right decision for my family? Is this the right neighborhood? Is this really what I want to do? And you're willing to usually pay more for something if it's worth it. Sellers are entering the marketplace this year, and that's what they're thinking. The buyers in our marketplace are entering, and they're still hoping for that. So what we're going to see is a standoff for the first few months of the year and a tension between these two. And the course of the year will unfold, and we're going to migrate more to a coastal market where I would say 6 out of 10 or 7 out of 10 real estate markets in the United States, they've already migrated more towards this worth factor. The people that are buying are seeing the recession in the rearview mirror, and they're not thinking recessionary. They're thinking about quality of life. They're thinking about their job is secure, and they're moving forward with things. And it's going to take a while for that to catch up in the Colorado Springs marketplace. When that happens, we'll actually see the more persistent growth in the market. But we're projecting right around 10,000 single-family sales. We're seeing somewhere between 1 and 4% appreciation depending on the neighborhood for the course of the year. More listings on the marketplace, higher interest rates, slightly slower buyer demand through each month, but more of a flat line and not quite the spastic craziness that we saw in 2014. Will we be right? Who knows? Tune in monthly if you like. It's a projection, but have a great new year.